Let's bring in Giorgio Caputo, who's overdue for some bond discussion with us, Senior Fund Manager at J.O. Hambro's Global Income Builder Fund. So, Giorgio, the 10-year has got my attention today. Does it have yours?
It's definitely got our attention. We've been it was quite interesting yesterday to note that the initial reaction to the FOMC meeting to essentially the shortening of the taper was to flatten the curve, right? And so you see kind of the historical interpretation that removing accommodation is bad for the economy. Today we're seeing something very different.
Yeah.
We're seeing kind of a very strong economic picture, kind of, tapering for the right reasons, if you will. Some news out of Washington on spending plans. Just a very different, very, very solid backdrop in the wake of the Fed announcement.
Now, when you look at the yield curve, there's different sections, and they do look kind of different depending on where you go. And it just got crunched again if you look at 30s to 5s or 10s to 5s. But if you take it a little bit closer and do a 10 to just a 90-day rate or something, or even a very shorter-term bond, that kind of spread widens out a bit, not as extreme. How come we're getting that big of a difference, Giorgio? When I look at the 10 to 30 to 5, for example, it's just a total dive throughout the month of September. A little bit of recovery here today, but if you shorten it up and look at a different section, you find something a little bit more economically positive like you're describing. So walk me through which parts you look at and what it means.
Yeah, so it's I mean, for us, the main thing that we're focused on, frankly, these days is real yields.
Okay.
Right, and they're still quite low, right? So we've only just managed to kind of crawl our way back over a negative 1% real yield, right? And so kind of when we think of positioning, the main thing we're focused on is that there's still quite a long way to go. And inflation expectations are pretty well anchored. So if you remember, we actually used to have positive real yields before the coronavirus, and we've had a little bit of a growth interruption. But with supply chain dynamics improving, perhaps some return to work, we could start the march back higher in terms of real yields. And frankly, if you've been waiting to get that mortgage, now might be a good time to run over to your bank.
I like that. So it sounds like you think we might be able to actually make some headway here in the 10-year. Giorgio, what do you think is? I'll make sure we still got Giorgio. Might have lost his video, but I think I still hear some audio over there. Giorgio, we got you. Or we lose you?
I'm still here.
Okay, you're still there. Great. So what seems reasonable in your 2021 outlook for the 10-year? I mean, we were on pace earlier this year. You could just draw a diagonal line through the trend, and it was taking us to 2%. But now a little bit unclear. Where do you think seems reasonable, maybe by year end?
Yeah, I think it is unclear. We had a pretty sizable move earlier on. So, I could give you a forecast, but it's almost certain to be wrong. But I think you're kind of right to focus on kind of the broader trend, right? So if we hold inflation expectations around the 2% range, if we can get back to, frankly, break-even real yields, that would push us north of 2%, right? And frankly, that's a much healthier level for a healthy economy to run at, right? More of a 2% plus 10-year bond yield, for a dynamic growing economy with a fair amount of stimulus still potentially in the pipeline.
A guy can dream, I guess. 2% plus. It looked like it was a sure thing in the spring, but now we're making a push. I mean, today's move is pretty sharp. Giorgio, do you think if the Fed goes in December, that yield can keep climbing, or is there a limit to the time frame for tapering that will allow yields to flourish? If the Fed turns out to say October, we go in November, does that then create more of a drop? Where do you think that point is that decides which way it goes?
Yeah, I mean, hopefully there isn't that narrow a confident or all that confident or all that land a helicopter on a small helipad. You know, I think the issue is that we've had this period, this growth scare, where we've been lulled into a little bit of a sense of tranquility. Today is a wake-up call, right? So in terms of fixed income investors, in terms of income investors, we are going to have to think more again about cyclical income, about flexible income. We know what happens to traditional fixed income when rates rise, and it's not particularly pretty. So, you know, that's now back on the table, and I think to some extent we're seeing some repositioning around that today.
And Giorgio, it looks like the view for real yields to climb is at least being expressed in gold, which is getting blasted today, down 1.5%. So when it comes down to your strategy here to bring it all together, when it comes to income, also the global capacity here, where do you want to be concentrated in your own approach right now to have decent income but also safe income? Is it still U.S. based? Are you looking abroad? And are they more cyclical businesses? Or are you hiding out in the debt from the giant tech players?
So there's really a bunch of things that are coming together. Frankly, cyclical equities are very attractive as well. You know, they've pulled back a bit just as we've had this growth scare with technology and traditional fixed income doing well. So it's interesting that you're seeing kind of both value and kind of market direction align. You know, there are businesses out there, financial businesses, industrial businesses that pay very attractive dividends, and they will protect in a rising rate pro-cyclical environment in ways that your traditional fixed income will not. Right. So from our standpoint, investors do want to start thinking about, you know, whether it's financials, whether it's potentially some businesses in the industrials, the materials sector. These are going to be excellent complements to your traditional fixed income portfolio, and can help, you know, dampen some of the losses as interest